What if I told you that inflation isn't just about rising prices? It's about rising money. Every time more money enters the economy without a matching increase in goods and services, the value of that money quietly shrinks. It's not magic. It's not random. It's basic economics. When governments or central banks print too much money, purchasing power falls and prices rise. But how exactly does this process work? And why does it affect everything from groceries to rent? Let's break down how money supply really causes inflation. Today we will talk about how money supply causes inflation. So before we start, make sure to hit the like button and subscribe to my channel. Inflation is one of the most discussed yet misunderstood economic phenomena in the modern world. At its core, inflation refers to a sustained increase in the general price level of goods and services over time, which leads to a decline in purchasing power. While inflation can be influenced by multiple factors, such as supply chain disruptions, geopolitical tensions, consumer demand, and production costs, one of the most fundamental and historically significant causes is the expansion of money supply. Economists across centuries, from classical thinkers to modern monetarists like Milton Friedman, have argued that inflation is closely tied to how much money circulates in an economy. Friedman famously stated, "Inflation is always and everywhere a monetary phenomenon," emphasizing that persistent inflation cannot occur without an accompanying increase in the supply of money. Understanding how money supply causes inflation requires a deep exploration of monetary theory, central banking systems, economic behavior, and historical case studies. When more money is created without a corresponding increase in goods and services, the value of each unit of currency declines, leading to higher prices. This process is neither mystical nor accidental. It is rooted in basic economic principles of supply and demand. To understand this mechanism clearly, one must first grasp what money supply actually means. Money supply refers to the total amount of monetary assets available in an economy at a given time. Economists categorize money supply into different measures such as M0, physical currency in circulation, M1, cash plus checking deposits, M2, M1 plus savings accounts and short-term deposits, and sometimes M3, depending on the country. Central banks, such as the Federal Reserve in the United States, play a crucial role in controlling the money supply. They do this through tools such as open market operations, interest rate adjustments, and reserve requirements. When a central bank purchases government bonds, it injects liquidity into the banking system, increasing the amount of money banks can lend. Lowering interest rates also encourages borrowing and spending, effectively increasing the velocity and availability of money in the economy. Conversely, raising interest rates and selling bonds can reduce money supply. However, when expansionary monetary policies are pursued aggressively, especially during economic crises, money supply can grow rapidly, setting the stage for inflationary pressures if not managed carefully. The fundamental relationship between money supply and inflation is often explained using the quantity theory of money. This theory is represented by the equation MV equals PQ, where M stands for money supply, V represents the velocity of money, how quickly money changes hands, P is the price level, and Q denotes the quantity of goods and services produced, real output. According to this equation, if the velocity of money and real output remain relatively stable, any significant increase in money supply will directly increase the price level. In simple terms, when more money chases the same number of goods, prices must rise. This concept aligns with basic supply and demand principles. When the supply of money increases relative to the supply of goods, the purchasing power of money decreases. Imagine an economy producing 100 units of goods with $1,000 in circulation. If the money supply doubles to $2,000 but production remains at 100 units, consumers now have more money competing for the same goods, leading sellers to raise prices. Over time, this increase in prices becomes widespread, resulting in inflation. Another crucial aspect of how money supply causes inflation lies in the role of expectations and consumer behavior. Inflation is not merely a mechanical outcome of numbers. It is also driven by human psychology. When people expect inflation to rise due to increased money supply, they adjust their behavior accordingly. Consumers may rush to buy goods before prices climb further. increasing demand and pushing prices higher. Businesses, anticipating higher costs and stronger demand, may preemptively raise prices. Workers demand higher wages to compensate for expected price increases, leading to a wage price spiral. This feedback loop amplifies the initial monetary expansion, making inflation more persistent and harder to control. Central banks are acutely aware of the importance of inflation expectations. If the public loses confidence in the stability of a currency, inflation can accelerate rapidly. Therefore, credible monetary policy and transparent communication are essential to anchor expectations and prevent runaway inflation triggered by excessive money creation. Historical examples provide powerful evidence of the link between money supply and inflation. One of the most cited cases is the hyperinflation experienced in Germany during the early 1920s. Following World War I, the German government printed vast amounts of money to pay war reparations and finance spending. As the money supply exploded, the value of the German mark collapsed and prices rose at astronomical rates. At the peak of hyperinflation, prices were doubling within days, and citizens needed wheelbarrows of cash to buy basic goods. A more recent example is Zimbabwe, where excessive money printing to finance government deficits led to inflation rates reaching billions of percent annually. These cases illustrate the extreme consequences of uncontrolled monetary expansion. While most modern economies do not experience hyperinflation, moderate inflation often follows sustained increases in money supply, especially when not matched by economic growth. It is important to distinguish between short-term and long-term effects of money supply growth. In the short term, increasing money supply can stimulate economic activity. During recessions, central banks may deliberately expand the money supply to encourage spending, investment, and employment. For instance, during the global financial crisis of 2008 and the COVID-19 pandemic, central banks worldwide injected massive liquidity into their economies to prevent collapse. These actions stabilized financial markets and supported recovery. However, if monetary expansion continues after the economy reaches full capacity, inflationary pressures intensify. When production cannot increase further due to labor shortages, resource constraints, or supply chain limitations, additional money only drives up prices rather than output. Thus, timing and scale are critical. Monetary policy must strike a delicate balance between stimulating growth and maintaining price stability. Another layer of complexity involves the interaction between money supply and interest rates. When central banks increase money supply, they often lower interest rates to encourage borrowing. Lower interest rates make loans cheaper for businesses and consumers, increasing spending and investment. While this can boost economic growth, it also increases aggregate demand. If aggregate demand grows faster than aggregate supply, inflation results. Additionally, prolonged periods of low interest rates can fuel asset price inflation, such as rising real estate and stock prices. Although asset inflation is different from consumer price inflation, it reflects the same underlying mechanism: excess liquidity chasing limited investment opportunities. Over time, asset bubbles may form, and when they burst, they can destabilize the economy. Therefore, monitoring money supply growth is essential not only for controlling consumer prices, but also for ensuring financial stability. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.